Hi, it's John Mousseau. I'm the CEO and Director of Fixed Income at Cumberland Advisors. It is Friday afternoon on March 11th. This week, bond yields up. Think about the 10-year Treasury at a 2, back to a 2. We've gone back and forth and back and forth, back at a 2. 30-year bond at a 236. They're up roughly about 22 to 25 basis points this week. Look at the muni bonds, up the same amount, pretty much. So there you're looking pretty much at a 184 and a 226. Ratios really didn't change too much. I think what's really important here is to remember is that the downshift that we saw in yields based on the Russia-Ukraine crisis gave some of that back this week. Why? We see the sanctions. We see some of the cooperation among European countries. We see companies like McDonald's and Shell Oil taking big hits to basically pull operations out of Russia to support the Ukraine effort. I think all of this is telling the markets that it is a slow walk back to normal, but it indeed is a walk back to normal. What did we have on the economic front? Well, this week we saw CPI up right along with expectations. CPI came in at 0.8. Right on line with expectations. The 12-month trailing number is now at 7.9. That is the highest in 40 years, yes. Do we expect it to go higher? Maybe, because we know what the price of gas is doing, we know what the price of food is doing, but eventually they'll start to come down. They may be exacerbated longer, the problems, because of what's going on in Russia and the Ukraine, but we think eventually those monthly numbers will start to look smaller as you get later in the year. What does that mean from a bond management standpoint? It means that when you look at something like the muni bond world, where I just showed you where you have yields basically at 92 or 93% of treasuries on AAA bonds, for your run-of-the-mill water, sewer, transportation bond, AA, A-rated, we're buying plenty of bonds that are in that 3 to 3.25, 330 range. That's over almost 100 basis points higher than treasuries, which means there's kind of a built-in cushion even if yields go up because, over time, we expect those yield ratios on the longer end probably to come down. Another sign that there's a little bit of normalcy, the bond fund outflows, which were pretty vigorous last week at $2.25 billion or more. Those were more or less exiting because it was risk off. Now you have some exiting because of some concern about inflation, etc. But as yields continue to head higher, you will start to see outflows slow down, eventually inflows come in. It is very impossible to time this perfectly. So we start to buy in to these higher yields, as we do it slowly but methodically. And the idea is, of course, that as those monthly numbers start to drop later in the year, we expect yields probably to come back down and inflation certainly to drop back down, not back to 2, but probably settle in that 3.5 to 4 range. And so, this is the time to really start going from playing defense to kind of a little bit neutral and eventually to get a little more offense. Thanks a lot. I hope you have a great week, and we'll see you next week.
Hi, Matt McAleer, Director of Equity Strategies. March 11th, just after the close, I'm with Dr. Leo Chen. We're going to discuss what we saw this week, what we may prepare for next week. I think if we're trying to pick out a couple of things this week, it's 2 dates I have in mind that I really want to have people take a look at, and that's January 24th and March 8th. Those were 2 nasty intraday lows, and we want to make sure in what we are adding capital to or interested in adding capital to are areas that are trading above those lows. If we're trading below those lows, we're still trying to find a bottom, at least in areas such as basic materials or energy or financials. If we're above those levels, we can have some comfort to trade against those levels. So again, it's been a tale of 2 markets, value versus growth. Another tough week for growth, especially today and into this afternoon. The selling was relentless in technology, and that really moved over into, a number of the growth areas. Value hung in there. You look at basic materials, you look at energy, you look at financials. Financials interesting, Leo, and I'd like to get your comment on this. We have seen Treasury yields down, right? We've talked about this. Fear in the market had money flocking to Treasuries, safety, security. This week, those yields came back up, 2% on the 10-year, up from about 170 a week or so ago. Yet there was still selling in the equity market, which tells me maybe some of that fear is gone, but being replaced by a real concern on inflation, right? The fear, that war fear, kind of took a back seat to inflation fear the last couple of days. So again, until growth can get that priced in, it's going to continue to be a tough spot for the time being. Important to stay balanced in your approach there. Leo, in terms of the quant work, and our viewers know you now, that a portfolio manager here at Cumberland with a specific focus on quant analysis and how that feeds into your market vol, leverage market vol, and sector strategies. Tell me a little bit about what your quant work looks like currently versus some other tough periods like November, December of 18, or March, we call it COVID March of 20. Any comparisons that can be drawn?
Of course, Matt. I thought we could take a look at history today. So first, compared to 2018, especially December 2018, we have a very similar buy signal strength this year. This year has been the strongest buy signal entry period since the bottom of 2020. However, we don't see a similar volatility reaction this year. The VIX, for example, has been only hovering around 30 this week, even though every single day the market movement on the S&P has been above 1% this week. We've had 2 days of 2% movements and 1 day of 3% movement this week, yet the VIX remains low. Another history lesson I would like to visit is that please keep in mind 1 out of every 11 months or so, there is supposed to be a correction in the market. Yet, we hadn't had one since 2020 bottom, which is March 2020, until this year, January. And that was about 21-month duration, overdue correction period. On average, in history, it takes about 4 calendar months for the market to recover from a 10 to 20% correction. And it takes about 56 trading sessions for the market to calm during this recovery. So if history is a lesson, we should be in the 6th inning or so of the game. The last part of the history lesson I would like to provide today is that let's take a look at seasonality. In history, on average, February is a negative month since in the past 80 years, being September being the worst month of the year.
Right.
However, if you look at March and April in history, about 60% probability says March and April will point to the upside. If that's the case, we might expect the VIX to continue to the downside towards end of the month and next month. And especially for April, the average returns about 1.5% in the past 80 years. We might see a VIX downward towards the mid-20s or even lower. That would help the market to recover as well.
Great information. Great information. History is a great guide to the markets. Nothing ever has a set timetable on it. Markets can't be switched on and switched off. There were some interesting divergences this week in the equity market. You've heard me say that word before. That term, to me, and to investors or traders that look at internals in the market, when we see positive divergences, it means when a market trades down, for example, to a previous low, the March 8th action down to the Jan 24 action, Leo. But there's actually some positive changes, such as the high-low ratio improved, or the momentum ratio, which some people call and look at RSI as something similar, not falling as far. tells us that although some of the broad indices are challenging those negative numbers, the internal actors or the securities within the indices are acting a little better. So are we halfway through a correction? Are we through a correction? We can't answer that today. The market will tell us that. We have to be able to remain flexible. And in terms of any capital that we have in cash or you have in investment accounts, if you're committing that capital, not a bad idea to do it in stages. Clients have heard me discuss that frequently. We can stage in buys. So in terms of next week, we have that double headache, double headline scenario. Russia, Ukraine, along with higher rates. Probably going to be with us for a while. It does appear that investors are starting to realize that perhaps this Russia-Ukraine scenario isn't a 1 month scenario. That this can be with us for a while. 3 months, 10 months, 3 years, don't know. In terms of rates, that's going to be an ongoing scenario. We'll get our first rate boost from the Fed this month, and I would imagine we'll see some regular ones with the inflation numbers as high as they are. Enjoy the weekend. We'll see you next week. Don't forget to like, comment, and subscribe, and turn on your notifications for any alerts during the week.